Good morning, or I guess good afternoon, everyone. Thank you for joining this webinar, this Nadex webinar, an introduction to Nadex knockouts and call spreads. My name is Todd Rich. I am with Nadex. I will be taking you through the session today. And if I sound excited today, it's because there was some really interesting news. Nadex is our parent company. We are owned by IG Group out of London. We've got IG US here in the States where they operate. But IG just spent $1 billion to buy Tastyworks, Tasty Trade. So interesting day for our company, as it appears we're going to be coming into the US markets with even a larger presence. Very exciting. You can go take a look at the news out there. So I'm kind of amped up about it. I'm still trying to digest it all. So let me focus and take us through this introduction session. Before I get into it, this webinar, as are all of our webinars, are sponsored by our compliance department. And I need to share that trading involves risk and may not be appropriate for everyone, that any trading decisions you make are solely your responsibility and at your own risk. And then please realize this is an educational session. Please do not construe anything I say today as a buy or sell recommendation. I am doing this for your education purposes. And that will become even more abundantly clear when I start doing a demonstration of the platform and we're actually looking at products. So, all right, with that, let's get that out of the way. I want to put this up at the beginning, and I will, in fact, probably bring this up towards the end as well. But this is important. We're here to help you. If you're not successful, then we can't be successful. So ideally, we want to have successful trading customers, people looking for short-term price action in the markets. And if you have any concerns or challenges, whether it's around our products, our platform, your account, whatever it is, please email us, customerservice@nadex.com. We clearly can't help you if you don't ask for it if you need it. The other thing I'm going to mention, if you could, and you have the opportunity to do so, if you could go to trustpilot.com/review/nadex.com and leave us a review, it would be appreciated. We like to get that feedback, and we are trying to build out that particular tool. I also want to mention you should follow us on social media. I want to point out in particular our YouTube channel. If you follow and subscribe to the Nadex YouTube channel, you will get alerts whenever we publish additional content, whether it's educational or market commentary. We are recording this session. It will be posted there. It will also be posted to our website. I will show you in the webinars archive section. The other reason I like to mention our YouTube channel is right now we are doing every morning for 15 minutes, we do some technical analysis. I actually do it with a great partner of ours, Brian Caprice from Keep Trading Simple, where we take a look at hot spots in the markets. We try to understand the news that might be impacting those markets, look at some technical levels, and try to point you to places where you might find some opportunities if you were interested in how you could leverage those within Nadex products. So follow us on Nadex YouTube, and if you find our live streams or upcoming live streams, we go every morning. They're recorded and immediately get posted to our YouTube channel. All right, what is our agenda for now? What is our agenda for today? And I want to cover two of our products. Our most popular product, binary options, far and above all of our other products. That's what most people come to Nadex to trade. But I want to share our other contracts, namely knockout options, knockouts, as well as call spreads. Now, I am going to just tell you a little bit about Nadex, who we are. I like to do that quickly at the beginning, particularly for all of the new folks out there. We are constantly getting thousands of new customers coming into our markets all the time. And I want to make sure people are familiar with who Nadex is, what it is we have to offer, and then I'll talk about the products themselves. In the end, again, as I mentioned, I am going to do a practical demonstration. Now, this can be an interactive session. On your console right there, you can type in questions. I will tell you, I will try to keep an eye out on those questions, and I will try to answer them as the best that I can. If I miss them during the presentation, I will certainly come back to them at the end. Odds are, if you have a question, there's a high likelihood that someone else probably has the same question, is just too shy to type it in. So please, by all means, please type in your questions. I will do best efforts to get to them. If for some reason I miss it, again, you can always email customer service at nadex.com. They'll be delighted to help you. All right, so let's get on with it. Who is Nadex? Nadex is actually short for North American Derivatives Exchange. A cool name, North American Derivatives Exchange, but Nadex just sounds a lot cooler. And what are we? We are a proper regulated exchange in the United States. Right? We report in, our regulator is the CFTC, the Commodities Futures Trade Commission. And we are registered both as a marketplace as well as a clearing entity, meaning we are vertically integrated. When you do a trade with Nadex, we're the one, you're trading on our exchange, you're trading with other participants, other market makers, you're not trading with Nadex at all. We are not the people putting the prices on the exchange. Our market makers and our members and our participants are. We are simply the exchange, like the New York Stock Exchange, right? And we are a clearing entity. Everything that, whenever you do a trade, our clearing entity guarantees performance on all of those trades. Now, what is it that we offer? Is we offer contracts designed specifically for retail traders. That is who comes to our marketplace. And when I say a retail trader, they're really contracts designed with very low cost to entry. And every one of our contracts, it doesn't matter which contract you're trading, whether it's a binary option, a knockout, or a call spread, every one of our contracts has very clearly defined, calculated upfront, maximum potential profit, maximum potential loss. So there are no surprises. Things like initial margin or maintenance margin or margin calls, that is not part of the Nadex world. All of our contracts are fully collateralized up front, and they are low dollar. I mean, our binary options are $100 contracts. Our call spreads and knockouts can be anywhere from $200 to $600, small notional value, and you can come in and you can trade and you can get access to short-term price action. That's what people are looking for when they come to Nadex. Often we'll use technical analysis or price action analysis, but it's for short-term trading. We are great for day traders, and the interesting thing there is, unlike other marketplaces where there are restrictions on day trading, particularly for retail customers, there are no limitations at Nadex. We do not have day trading restrictions. You can buy or sell a contract as frequently as you like throughout the day. Right? And that's what people come to Nadex looking for. And we've got products that are represented in the indices, whether it's US indices, the Dow Jones, the S&P 500, the Russell 2000, the NASDAQ, or there's some international indices, the Nikkei, the DAX out of Germany, the FTSE out of London. But we also have a lot of foreign exchange pairs, as well as commodities, gold, silver, natural gas, oil, some of our more popular products, oil and gold. So we've got a variety of markets where you can get short-term price action and do day trading with very small amounts of money and not have to worry about things like margin call and things of that nature. That's what Nadex offers. That's who we are. Now, I mentioned binary options. If you were interested and you don't understand binary options, last week I did an introduction to binary options that is recorded and on our YouTube channel, and it is also on our website. I will point that out to you. Today, we're covering knockouts and call spreads. And I'm going to start with knockouts because I think knockouts are our most intuitive product. And by the way, I was asked, is Nadex only for U.S. residents? And the answer there is no. On our website, you can look and you can see all the countries where you can access Nadex. You can't access Nadex from everywhere in the world, but from a lot of places in the world, you can access Nadex markets. And it is posted on our website, where can you access Nadex. And it is important that I point out, as I mentioned, we are regulated in the US, but you can access it from outside the US. And that is actually something that differentiates us from other, say, binary options exchanges. I know people have access to other binary options exchanges on the internet. And to that, I would say caveat emptor, buyer beware. If you ever had any challenges or needed some recourse, when there's no regulator, there is no recourse. Here, you've got recourse. We are regulated, and that is something that makes Nadex different. We are the premier binary options exchange in the United States. Almost all binary options volume on a regulated exchange goes through Nadex. There is one smaller binary options exchange where they trade weather contracts. So, but thank you for that question. I want to jump into knockouts. So what are knockouts? And knockout, it's a contract. It's a contract that trades within a set price range. And that range has two levels, right? And we're going to call the lower level the floor and the higher level the ceiling. Very simple. You trade a knockout, here's a contract, and it's got a floor and it's got a ceiling, and the price of that contract is going to trade somewhere between the floor and the ceiling. All right. And the interesting thing with knockouts, and this is why I like to start with them, is they are definitely the most intuitive contract we've got. It is what we call a Delta 1 contract, meaning it trades right in line with the price of the underlying. Now, I'm going to use gold as an example. Gold is trading right around 1860. If you were to trade a gold knockout on Nadex, the price that you're trading is the price of the underlying. It's going to be, hey, if I think gold's going higher, I can buy it at 1860. If I think it's going lower, I can sell it, right? It trades right in line. It's pretty much like any other asset that you would trade. You can buy and you can sell it. And a Nadex knockout, the price you see, it should approximate very closely, if not the same, as the underlying at that moment. So hopefully that is pretty straightforward. So again, you think it's going up, you buy. If you think it's going down, even though you don't own it, you can sell it and take a short position. So if I thought gold were going lower, I can just simply take a short position, sell a knockout, hoping to profit if the price of that knockout goes lower. If the underlying asset, if gold were to go lower, I could benefit and buy it back at a lower price, or let the knockout do what it does, which I'm going to get into right now. So how does a knockout work? A knockout can expire in one of two ways. There are two ways for a knockout to expire. And the first is called a price triggered settlement. So they can either expire by price or by time. And what does price trigger settlement mean? When you trade a knockout, it's trading between two levels. It's got that floor and it's got that ceiling. And as the price of that asset goes up or down, the price of the knockout's going to go up or down. But if the price touches either the floor or the ceiling, you get knocked out of the trade. That's why it's called a knockout. Very intuitive. So if I buy a Nadex knockout and I think it's going higher, if it gets up to the ceiling, I get knocked out of my trade for maximum potential profit. It essentially forces you to take your profits if you're right. Now, conversely, if you buy it you think it's going higher, but it goes lower and it touches the floor, you would get knocked out of the trade as well. There you would get knocked out for maximum potential loss. Essentially, it's a stop loss. It forces you to be a disciplined trader. When you're trading, discipline is very important. A Nadex knockout bakes that in, part of that trading plan, into your trading. If you think it's going up and you buy it and it hits that price level for a profit goal, boom, you take it, you're out. If it goes down and you're wrong, boom, all right, you got to take your lumps, but at least you took your lumps. Conversely, I can sell it. As I mentioned before, if I sell an 8x knockout because I think the price is going lower and it touches the floor, boom, you're going to get knocked out and you'll experience maximum potential profit. You sold it, it went down, it touched the floor, and you're knocked out. Now, if you sell it and you think it's going down, but it goes up instead, you were wrong, and it touches the ceiling, you would get knocked out from maximum potential loss. It stopped you out in case you were wrong. Now, the other way a knockout can expire is time. All right, so all of our knockout contracts, they start at the beginning of the week and they end on Friday. So they're weekly contracts. Now, as the price moves throughout the week, contracts will get knocked out and we're constantly listing new ones. But let's say for some reason, by the time that you trade a knockout, it doesn't touch either the floor or the ceiling. It goes up and down and up and down and up and down. And the end of the week comes and there is an expiration time for the contract and it hasn't hit either the floor or the ceiling, it will settle. All right, so at the end of the week, there is a time triggered settlement. It will settle, and your profit or loss would simply be the difference between where you bought it or sold it and where it ultimately settled. Okay, so if I bought it and it trades up and down and up and down and it closes higher than where I bought it, I'd have a partial profit. If I bought it and it settled lower, I would have a partial loss. Now, if it ever touches one of the boundaries, you're knocked out and you experience maximum potential profit, maximum potential loss. I think that's all pretty intuitive and pretty straightforward. Hopefully no one has any challenges with that concept of a knockout. And that's why they're called knockouts. It makes perfect sense. You are knocked out. So as I mentioned, each knockout has a duration of 1 week. At the beginning of the week, we list 4 knockouts for each one of our products. And if a floor or ceiling of that bracket is touched, a new knockout is listed. And for most circumstances, there'll always be 4 knockouts. Okay, so every time one gets knocked out, we try to list another one. Now I'm going to show you just a little bit of an example. I like to walk through this on the slides and you can see how it actually works. And then eventually I'm going to jump over to the platform and you'll see it, how easy it is to understand when you look at it on the platform and actually want to trade them. Here's an example in the S&P 500. And when I built this example, it was trading right around 27.20. Doesn't really matter what product it is or what the price is. Just know that we open a contract at 27.20 and we're going to put 4 contracts that give you a range for you to choose from. And we have there's a way to set these up where initially we take the current price and we go 10 points lower, that's the floor. We go 40 points higher, that's the ceiling. And then we repeat that process, 20 points below, 30 points to the ceiling, 30 points below, 20. So there's always a range of 50. Now, not all of our knockouts have a 50-point range. This is for the S&P 500. For each one of our contracts, there's a set parameter to determine the range, but the logic is exactly the same. You're going to have 4 knockouts at any given point in time. Now, let's take a look at what happens once the market starts trading. So here we are, we know we're at the S&P 500 at 27.20. That's that black line. We have an expiration at the end of the week, and we've got our four knockouts. Now, what happens? The market starts trading higher. Oh, look at that. When it started trading higher, boom, it actually touched the ceiling on knockout number 4. So what happens to knockout number 4? If someone had bought knockout number 4, they would be knocked out for and you can see they made a little bit of a profit. If someone had sold knockout 4, they would have got knocked out for a loss. But when knockout 4 expires, it is gone. It is done. Now, because the price had gone up a little bit, we're going to add a new knockout that is above that so that we always have 4 knockouts. Now, let's take a look at it the other way. Let's say we start the market right here at 27.20 and it starts trading down. Well, you can see that it actually hit the floor of knockout number 1. So knockout number 1 is now gone. And as it has gone lower, we need to extend our range of choices. We'll add a knockout down below. Again, you'll always have 4 choices to choose from, or usually have 4 choices to choose from. Now, what happens if it doesn't touch a floor or ceiling of any of the knockouts? And that could actually really happen towards the end of the week. Now, before I walk through that example, we call knockouts a variable payout at final expiration, meaning we don't know. And the reason we distinguish that is because our binary contracts, our binary options, they aren't variable. They're either going to settle at 0 or 100. So it's a little bit of a difference. With knockouts, your profit or loss are determined between where you buy or sell and where the final settlement is, or if you get knocked out. So let's take a look at an example here. We're at the end of the week, okay? And this is that it had gone on all week and we have knocked out contracts and we've constantly listed 4 more. And here we are at the very end of the week. And these were the 4 knockouts that we have. And let's just say that it trades. Look at knockout number 4. All right. You buy or sell that bracket 4. It never went anywhere. And then expiration happens. Boom. All right. Now it's going to settle. Your profit and loss would simply be the difference between where you bought or sold it and where it finally settled at the end of the week. So it's just a graphical way for me to kind of show that to you. Now let's talk about risk and reward. With a knockout, your maximum potential profit or maximum potential loss are always known before you enter the trade. Okay. In fact, we even calculate it for you on the order ticket. And again, I will show that to you. And the floor and the ceiling are simply providing boundaries. And this is sort of a way to force you into a trading plan where it gives you clear, natural profit targets with defined risk control. You know where you would potentially make maximum profit if whether you're buying or selling, and where you would be stopped out if you were wrong. All right. Now, on the risk side, I'm actually not going to go through all the calculations, but it's pretty intuitive. Your risk, if you buy, is the risk between where the price you pay it and the floor. Okay. And a seller, if you sell a contract, your risk is, if you sell it, is the difference between where you sold it and the ceiling. Now, the reward is exactly the opposite. If I buy a contract, all right, my potential reward, if I buy it, is the difference between the price that I paid and the ceiling. All right, that's where my maximum potential reward is. And a seller's maximum potential reward is the price that I sold it down to the floor. And we do all those calculations for you so that you don't have to sit there. And I mean, when you look at our charts, and I'll show you, you can visually see that, but on your order ticket, we calculate it for you. All right, so I just want to kind of show you, this is kind of another cool way to visually see it. I'm going back to that example for risk and reward where bracket 1, okay, we're looking at bracket 1. The market is just starting to trade and you wanted to buy one, okay? When you buy it, all right, I know right now in my moment in time where I'm buying it, I know where expiration is. That's the right line below. I know where my floor and I know where my ceiling are. Excuse me, I just need to take a sip of tea. I'm choking. All right, much better. All right, so when I buy this knockout, all right, I know where I'm buying it. I know this is my point in time. That's the dark black left on the line on the left. I know where expiration or potential settlement is on the right. I know the floor of my contract. I know the ceiling of my contract. So I'm buying at this price. This is where we are right now. My risk, because I'm buying it, is if it were to drop and touch the floor, that is what I am risking. And what am I potentially getting if I get maximum potential profit is if it goes all the way up to the ceiling. A very visual way to cleanly see my risk reward if I am buying. And that is rather interesting. I'm getting uh, a knockout. Could it be is it similar to a collar? And the answer is, and this might be a little over some people's head, but I am very strong in the equity option space. I come off the trading floors. I work for the New York Stock Exchange. I did this exact type of training for E-Trade before coming here. It is similar to a collar. The collar gives you that protection where you've got the protection to the downside and you've got that profit level to the upside. The difference is when you own those options, there's optionality involved. You're not knocked out of the trade. Here, you are physically knocked out of the trade, and interestingly enough, there are no premiums involved. When you buy a put, you got to pay money for that. When you sell that call, you're going to collect a little bit of premium, but somewhere in there's going to be some extra math that you have to do. With a knockout, you don't have to worry about that premium at all. Now, take that concept and pin it up because we're going to have some fun when we talk about call spreads. So you got a step ahead of me, but it's a great question. The collar, there's going to be that optionality around it, and that is actually what a call spread is, but we will get there. All right, so for a knockout, you are knocked out of the trade. That is it. You can see your risk. You can see your reward. It's very clearly defined. Let's take a look at the flip side. All right, I want to show selling one. Now, by the way, if you notice, the examples I'm choosing when I buy, I'm kind of picking one where the floor is close to where I'm buying. That's keeping my stop loss very tight. You don't have to necessarily do that. I could trade in brackets 2 or 3. When I'm selling, I might want to keep my stop loss if I'm wrong, that ceiling close to where I'm selling because I'm trying to keep my stops a little tight. But again, you've got to choose the risk reward ratio, the risk reward profile that suits your trading. Now, I am going to show you the exact same chart for risk reward when selling. I've got my buy point on the black line. I've got my sell point on the red line. I've got my ceiling up above, my floor down below. I think the S&P is going lower at 2720. Now, where is my risk? If I sell a knockout, it's if it goes up and touches that ceiling. That's the amount of risk I've got. That's what I could potentially lose. And my maximum potential profit is it makes it all the way down to the floor. So you've got to choose a knockout where the risk reward, the red area to the green area, fits within your risk profile, what you're comfortable with. Because if you touch either one of those boundaries, the ceiling or the floor, the contract will settle and you will be knocked out either for a profit or for a loss if it touches one of those. So in terms of capital requirements, I mentioned we don't have margin call, and we don't, but your capital requirement is your maximum risk. Whenever you trade a knockout, you've got to put up the most that you could potentially lose. At that point, there'll never be another margin call. Your capital requirement will never change. When you initiate the trade, you put up the maximum that you could potentially lose, and that's it. Now, it'll keep trading. You'll either get knocked out of the trade or you can trade out of it. I am going to come back to that, at which point you reset the clock and you start all over, look for another trading opportunity. But it doesn't matter whether you're buying or whether you're selling. Your requirement is simply to put up the maximum that you can lose. And the reason that we offer 4 different brackets and we offer multiple levels of knockouts is so that you can choose how much you're willing to risk to make to what you're potentially looking to make. And that is that risk reward ratio that suits your trading style. Now, on the order ticket, I told you I would show you an order ticket. Here's this example. It will tell you on the order ticket, here is your floor, here is your ceiling, and here is when it's going to expire. It will, and they're all set to expire Friday at the end of the week. They're all set to expire at the end of the week. By the way, notice in the upper left-hand corner, there's an indicative price of the underlying. And as I mentioned, it's a Delta One product. That indicative price is generally going to be right between the bid-ask spread. Okay. We also tell you when it's expiring. This particular one was 1 day and 21 hours, but we will have prices. There are market makers who stream bids and offers, but then again, any participant can put prices in. Do you have to trade on the bid or the ask? No. And I will show you that. If I want to try to buy one of these and I wanted to try to pay $36.74.80, I can post a bid $36.74.80. And now, will someone trade with me? I don't know, but I do not have to buy the offer and sell the bid. I can absolutely put a bid or an offer in between the spread, and there might be somebody else who is participating in Nadex markets that wants to trade with you. We have what is called a central limit order book. Anyone can post liquidity. Anyone can take liquidity. It is what it is. What you see is what you get. So you can trade between the bid-ask spread. You can even put a bid below the market or an offer above the market. There's nothing precluding you from doing that. Anyone can post into the order book. So it's not limited to just, say, market makers. There'll be a price on your ticket. Now, you can use a limit order. You can use market orders if you like. It all depends upon your preference. You adjust the size of your position. I usually use a 1 lot as an example so that it makes it very easy for you to see what your risk reward is. If I were to try to buy one of these, you can see buy is in blue. If I were looking to sell, the big sell would be red. So this blue is I'm trying to buy, the right side of the ticket. I'm trying to pay $36.74.50, right between the bid-ask spread. If I bought one there before I even placed the trade, it tells me if it went down to the floor, you could potentially lose $125. If it touches the ceiling, you could potentially make $375. That is your maximum risk. That is your maximum reward. We calculate it for you. You don't have to do the math. We show that to you on the order ticket before you enter a trade. You know what you're getting into. Now I want to switch gears a little bit. And I'm not going to have to spend as much time with call spreads because once you understand knockouts, all right, a knockout, it's a Delta One product, very clear, distinct floor and ceiling to knock you out of your trade, whether you're buying or selling. That knockout will settle if it touches one of the boundaries. And if you bought it and it went up, great. If you bought it and it went down, oops. Converse if you sell. Now, let's talk about call spreads. A call spread also is a contract that has a predefined range, right? And that range also has a floor and a ceiling. So nearly identical to a Nadex knockout. Now, the value of a call spread is going to move with the underlying market as well. Similar, very similar to a knockout. So it's going to look very much like a knockout, but call spreads differ from knockouts in 2 distinct different ways. Okay, and this is really important. This is the difference between call spreads and knockouts. And some people like knockouts because it is Delta One, it is very straightforward, it is very clear, and that's it. Others like knockouts, like call spreads, because a call spread Remember, a knockout had two ways of settling. It would either, you would get knocked out with a price trigger, or it would settle at time, a time trigger. Call spreads only have time triggers. Only have time triggers. They do not get knocked out if it touches the floor or the ceiling. There is no price triggered settlement in call spreads. So call spreads actually have optionality in it. And we were talking about this briefly earlier. It was a great question. That is the difference between call spreads and knockouts, is because a call spread doesn't settle if it touches the floor or the ceiling, there is inherent optionality baked into it. And so because there's that optionality, the volatility of the market, if this thing's moving all over the place and swinging up and down, or if it's dull, if there's no volatility whatsoever, that will impact the price of a call spread. That does not impact the price of a knockout. A knockout is delta one. What you see is what you get. That's it. A knockout is going to have a volatility component. It will also have a time to expiration component. Because it can go on for an entire week. The longer there's time in a call spread, you have a longer time to be right. So it's going to be baked into the price, and there's going to be a premium baked into the price of a call spread. Whether you're buying it or selling it, there's going to be a variance between what you're paying, or the price that you're selling at, and the price of the underlying where it is right now. And that premium component will take into consideration the volatility of the product and the time to expiration. If you get into the last hour, or two of a call spread at the end of the week, it will be almost identical, if not identical, to a knockout. At that point, there's no time left, and the volatility component with only an hour or two to go is going to be very little. So there is time decay with a call spread. Early in the week, there's going to be extra premium because there's a lot more time. Late in the week, less. All right, now, if you take nothing else away from this session today, this is an important rule when trading knockouts or call spreads, and that is, and this is actually true for binary options as well, all right, or any options for that matter. Just because there's an expiration associated with a contract does not mean you need to wait to expiration to see what happens. I want to say that again. Just because there's an expiration associated with the contract does not mean you need to wait until then in order to see what happens. All right, you can trade out of it early. All right, you can choose to exit a position early. And why would you want to do that? You can exit it early to either take a profit or to stop your losses prior to expiration. I will tell you that more successful traders at Nadex don't wait until the very end and get surprised on how it's going to finish, whether it's going to be for a profit or for a loss. Most traders don't like surprises, so you've got to always factor in the risk reward at that moment in time. All right, as if you are partially right and you like your profit and you want to take your profits, you can always, the saying is, no one ever went broke ringing the cash register. Hey, take your profits, move on to another trade. And the other thing that you'll hear people say a lot of is, a lot of trading is about minimizing your losses. So now, while we've got defined risk, defined reward contracts that is inherent, those are really your guardrails around your trade. You can actually have guardrails inside the guardrails that fit your risk reward profile. All right, we built them into the contract to hard code some type of maximum risk, maximum reward to help you. because that's a lot of people have a difficult time defining that in their trading plan, but you can always fine tune that, and you can trade in or out of a knockout or a call spread to either lock in profits or limit losses prior to expiration. I cannot hammer that concept home enough. Very important. That is your big takeaway. Your big takeaway. You do not have to wait till expiration to see what happens. All right. Again, I wanted to come back to this at the end. If you've got any questions, please email us, customerservice@nadex.com. We are here to help. All right. Yes, I've recorded this session. It will be up on our YouTube channel, or you'll also be able to see it on the Nadex website in the archive section. I'm going to show you that as well. And again, I'm going to put that little plug in there. If you could give us a review on Trustpilot, trustpilot.com/review/nadex.com, we would greatly appreciate it. All right, and I think I've been getting to the questions as we've been going along. What I'd like to do now is I'm going to change gears a little bit and do what we call off-roading. I want to show this to you. My mom is from the great state of Missouri, however you want to pronounce it, and it is the show me state. I find that when people see this in action, it tends to resonate a little bit better. All right, now I just want to make certain I'm going to check this. You should be looking at the Nadex website. Yeah, I can see that you are. Awesome, fantastic. Okay, so before I go into the platform, I do want to point this out. If you go to Learning and you go to Webinars, I'm going to click on that. You will see our upcoming webinars. I've got webinars out through next week. I will be posting today and tomorrow webinars out through January. You can feel free to come and register for any of these when you like. I know you get emails and there's other ways of notifying people, but you can always choose to come here on your own and just see what's coming up. I am going to point out the archive section. This is where you will find all of our recordings. They are also available on our YouTube channel. I can't hammer that home enough. You go to YouTube, you look up Nadex, subscribe to our channel, go to the video section. Not only will you find these videos, you'll find a variety of other content, and that is also where you will get our Nadex morning analysis sessions. In fact, our chief commercial officer, Travis McGee, does a one and a half minute blurb very early in the morning. Hey, get ready for the trading day. It's very motivational, and it kind of gives you some of the news, just things that you might have missed as you're waking up and you're trying to take a look. Nadex morning analysis, 8 a.m. Central every day, 9 a.m. Eastern. And we spend 10 or 15 minutes and we'll listen to that news, but then we're going to go to the charts. And then we're going to do some technical analysis, price action analysis, take a look at the actual hot spots. Where are things moving around? What you might want to be looking at, and we show it to you on the Nadex platform. You can always choose to join us. You just got to go to our YouTube channel, and it'll be part of our live streaming. I did get a question also when I say delta 1 and we're talking about a binomial distribution. When I say delta 1, I mean it's 100 deltas. In options terms, it would be a deep in the money call or a deep in the money put. The price of the actual option moves exactly in line with the underlying. So our knockouts, you look at the underlying, our knockout price will move directly with that, period. Now, call spreads, very, very similar, but remember, volatility and time to expiration will be factored into that call spread. So the call spread is going to not be as rigid in the price movement of the contract in line with the underlying as it will be with a knockout. So hopefully I was clear on that. By the way, if you missed it, we just did 2 days ago a New Year, New You, Better Trader full education day. We've got 4 of the recordings up here now. There's 2 more to come. They will also be on our YouTube channel in a nice clean playlist. But if you wanted to go back, it was a full day. Oh, give me 1 second here. I've got to share my screen again. This happens sometimes. Let's go back to, and I apologize. There we go. Okay. Sorry about that. I started the day, by the way, we did basics of technical analysis. If you're not familiar with technical analysis, this webinar would be a great one to catch. What is technical analysis? Why do you even care? Who invented this stuff? This candlestick chart, you mentioned charts. What's a candlestick? Very basics, some basic chart patterns, trends, channels, support and resistance, basic technical analysis. One of my colleagues from Daily FX took us to the next level with intermediate technical analysis. Then we had another one of my colleagues that started off with fundamental analysis. What are the fundamentals in the market and how do you trade around specific events? Then we had Brian Caprice come in and talk about trader psychology. Now, the last 2 sessions that we haven't gotten up there yet, we had a third party from Yellow Tunnel, Vlad, who discussed building a trading plan and looking for entry and exit points and being data driven. That recording will be up shortly. And then the day was wrapped up by my colleague, Dan Cook, who talked about volatility. And he really spoke a lot to using Nadex binary options, knockouts and call spreads, and how you could trade volatility in a volatility matrix with Nadex products. So there's a lot here. I wanted to point it out to you. Now, I am now going to log into the platform, and I'm going to go into a demo account. Now, if you do not have a demo account, I recommend you get one. It doesn't cost anything. Anyone can sign up. In fact, you can go to our website, find a demo account. If you're on YouTube, we have a link on every single page on how to open a demo account. It is a great way for you to become familiar with our platform and to practice trading our products. Right now, if you've never seen this before, I like our new dark theme. You'll notice on the left, we've got where our products are located. Down below is where you would manage your open orders and your positions. You can even find your history. And then the main console, where you'll see the charts and the order ticket. Now, I am going to give us a little bit more screen real estate. And let's start with knockouts. And since I mentioned gold earlier, I'm going to click on commodities. I'm going to go to gold, and I'm just going to pick. You'll notice there are 4 4 knockouts for every single one of these. It doesn't matter. All of our products have 4. I'm just going to click on one of them to populate the chart. I am now going to hide the product page, and we got a 15-minute chart. That's fine. All right, and let's just take a look here. Okay. Now, you can clearly see that we're looking at gold. By the way, our charts are totally customizable. You can pick your time interval for your candlesticks. Currently, I got a 15-minute just set. I think that's a pretty standard one to use, but people have to choose what they want to look at for time frames. You can look at your date range that you would like the chart to populate. We've got a variety of technical indicators baked into the platform. You simply click on one of them and it will populate the platform, and you can adjust it accordingly if you wanted to. You can modify it, or you can just use the standard ones that come with it. If you're not familiar with what one of these technical indicators are, you can hover over the eye we have in platform education, where you get a little bit of information about what that technical indicator does. All right. I'm also going to point out that we've got drawing tools, whether you want to put your own technical analysis, support, resistance lines, channels, trend lines, pitchforks, even Fibonacci. If you, again, I'm not going to go into all that. You can go back and listen to what we covered on our recordings, but I just want you to know that it's completely customizable. You can change how the things look, how they feel, and we've got some webinars on there on how to navigate the platform. Now let's talk about knockouts specifically. Notice There are 4 blue vertical lines on the left-hand side. That's why it didn't matter which knockout I clicked on. I can switch between any of these knockouts by simply clicking on that contract. Now, it gives me the floor and the ceiling, very clearly defined. I can see it on my chart. Here's the ceiling, here's the floor, and here's the current price. Now, if I thought gold were going higher, I could click buy either here or on the order ticket. And notice, if I were to buy right here, we're at 1864, we're right around 1864. If I bought one here, let's make this 1864 even. I want to make it even. How much could I make? How much could I lose? I'm actually going to place this order. I want you to see 1864 go in. Oh, there's my one lot. And remember, I am in a demo. A demo environment is not going to be identical to a live environment because I don't know who's looking. Now, I didn't do it quickly enough, but you saw my order was in, and it would have been in this little panel here. I traded it. Someone sold it to me, and I can see now I've got a position in gold. I bought one. It tells me that I bought it at 1864, and right now I would be losing $2 if I sold it right at the bid. All right, but I can manage, and I've got my history. I can take a look at my history. I can look at my positions. Now, if I want, all right, I bought one at 1864. Now, if it goes down to the floor and if it touches 1847, I would get knocked out for a maximum potential loss of 170. Goes up higher, I could potentially make 330. Do I have to wait until then to see what happens? And again, the answer is no. If this goes down to 1858 and I go, I made a mistake, get me out, I could always choose to simply sell it at a lower price and take a partial loss. All right, it would be a partial loss because I bought it at 1864. Now, do I have to wait for it to go all the way up to 1897 to get a profit? No. I also told you I can put bids below. I could put offers above. Maybe if it gets to what did I pay? 1864. Let's say it goes up to 1874. I'm just looking at the chart here. It kind of went up to 1874 earlier in the day. Could I sell one at 1874? Yes. I simply say I want to sell. I put in 1874. Okay. So I want to sell it. Notice it says sell. And I'm putting in 1874 as my price, which is 10 points higher, which would give me a $100 profit. I can place that order. My order was received, and we can see I am trying to sell one up at 1874. Okay, and it is currently trading 1864.10. Hey, I'm making 10 bucks. Or I mean $1. I only did one. I did a one lot. I'm making $1. So can I trade? Can I put offers above? Yes. Can I put bids below? Yes. Can I put a bid or an offer in between? Yes. Is someone going to necessarily trade with me? I don't know. All right. These are knockouts, very intuitive, very clear. I think I've covered knockouts enough. Let's go ahead now and jump over and just take a quick peek at call spreads. And let's pick a different product. I'm just kind of curious what's going on today in the S&P. Now, notice we've got a variety of expirations. All right, I could do a call spread, and this one's going to expire here in 5 minutes. There's another one that's 2 hours later in the afternoon. Then there's, this is the one, and we've got daily call spreads. Knockouts, notice they are all weekly contracts. Knockouts are weekly. Call spreads, I've got a variety of choices. All right, and it's different time slots throughout the day. For posterity, just in case, on binary options, that is where we see 5-minute contracts, very fast moving. And again, if you don't know binary options, review the webinar from last week. 20-minute binary options, and they're binary options. I mean, we can every couple hours, daily, weekly. We have a variety of different times. Let's go back to call spreads. I'm going to click on an indice. Let's just take a look at the daily call spreads that we had for the S&P 500. I'm going to hide that. Now, it looks a little different. You can clearly see I'm on this call spread where the range is 38.20 to 38.60. It tells me in the order ticket. And here we highlight the range of the call spread. Okay, let's move this down. I'm going to make this a little bit bigger. All right, now, if I mean, we're right in the middle of this call spread range. If I thought we were going to continue, it looks like we went high, we rose in the morning and now we're selling off. If I thought we were going to continue to go lower, I could sell this call spread. If I were to sell it right here, now notice, it's actually kind of close where the indicative price is, but if I were to sell it and it were to go higher, my maximum potential loss 198. If it were to go down lower, my maximum potential profit would be 202. Now here's the difference. All right, if I sold this and we went up and we touched this, the ceiling, we touched 38.60, I would not be knocked out of the trade in a call spread. It could keep going. It can go to the moon. I can't lose any more than 198. But if it goes all the way up here and settles here or higher, I will have lost $198. Remember, this will settle in 3 hours and 18 minutes. The only time that triggers a call spread is time. If it goes down, all right, I was right. I sold it. Now, if it touches the floor, 38.20, I am not knocked out. It can keep going down, down, down. It could go down a ton. My profit is limited to $202. It's a call spread. I cannot make any more than that, even if this thing kept going lower. Now, the important thing is I'm not knocked out. If I were to go down here, and let's say it starts to trade 38.10, and we're all the way down here, I can't make any more money on this contract. I mean, my maximum profit's 202, but I won't get that until it settles in 3 hours and 17 minutes. And what could happen is it could come all the way down here. Hey, I made all this money. This is great. And then all of a sudden it just skyrockets at the end of the day. And I could potentially end up losing. And I can even potentially experience maximum potential loss. So if it were to actually trade all the way down here, at that point, I sold it. It came all the way down here. I might just want to buy it back and say, thank you very much, right? So that is what's important, is you need to exit a call spread if it's going your way to lock in your profits. Otherwise, it could turn against you. Now, on the flip side, if it hits your loss, maximum loss, you still have an opportunity. You have more time to be right. Now, we do on these, we give you the shaded region so you can see what is it you're looking to do. And you can see if I thought we were going to go higher from here, this might be, I could pay. Now notice, here's a premium. When we're right near it, notice that, this is important. When I'm buying this, hey, the floor is 38.40, and we are just we're up here at 38.42, so it's already in this range. But what would I have to pay to buy this? I'd have to pay 38.46. I'd have to pay, way up here, 38.46. There's 4 solid points of premium in this contract, even a little bit more. Because if I'm wrong, listen, I'm only risking $65. But if I'm right, I've got some upside potential, but I am paying a premium to do this. What I would have to pay where this trades is above the current indicative price. That is the premium component of call spreads. With that, we have actually gone a full hour. I want to thank everyone for joining me today. I believe I got to everyone's questions. Again, this was recorded. You can catch it on our website when I get the recording rendered. You'll catch it on YouTube. I want to thank everyone for joining us. Be sure to check our website for upcoming events as well. If you don't have a demo account, I recommend you get one. And with that, I want to wish everyone good luck in the markets.